All agricultural businesses face a number of similar planning and reporting challenges, including the ability to predict seasonal revenues, expenses and related cash flows, match revenues earned with the cost of products sold, maintaining inventories, especially livestock, at fair value, calculating seasonal funding requirements, comparing performance to regional averages, and monthly reporting of actual and forecast results. So let's now look at an example of a corporate dairy farmer and see how driver-based forecasting solves their planning and reporting issues. Going into the software, we'll first look at the key operational drivers. Here we can see 10 dairy units called Farm 1 and Farm 2, etc., located in differing regions. Although there is a common ownership in this example, each entity would normally be a separate business model. If we first look at the key drivers for Farm 2, we can see that the production drivers include effective hectares, effective milkers, kilograms of milk solid produced, the dollar kilogram of milk solid payout, and other drivers include feed and fertilizer, dollar cost per tonne and per hectare. There are 5 reasons for this list of drivers. First, they enable performance comparisons between each unit on the same cost and return basis. They enable performance comparisons of each unit to regional statistics. They enable the coordination of the significant feed and fertilizer purchases with suppliers. They enable the calculating of the funding requirements from a corporate perspective. And they also provide a valuable method for each farm manager's input into the forecasting and reporting processes. If we look at how revenues are calculated, we can see that they're based on the kgs of milk solids produced times the predicted milk solid rate, and for this farm, less a share milker revenue share. To generate the balance sheet and cash flows, key assumptions detail how the payout advance and retro payments work. See here that the assumption for July starts with an advance payment due 1 period following, followed by a tail of payments starting 8 periods later and extending 15 periods well into the next season. So if a variable like the expected payout rate changes, the impact on the balance sheet and cash flows can be seen almost instantly. Other income is based on animal sales at estimated unit prices. Here we can see 20 cows being sold for an estimated $1,750 each. Under direct costs, we can see a number of different types of expenses, including direct farm, farm working, motor vehicle, and feed and fertilizer expenses. Cost of stock sold is variable on sales units and is based on the estimated value of cows sold, as well as generating a marginal loss on sale. Cost of sales of livestock reduces livestock inventories. Fair value adjustments allow for non-cash increases or decreases in herd values. Feed and fertilizers are linked to the drivers so that as the cost and quantities are updated by the farm manager, so do the costs, cash flows and the effect on projected bank balances. See here that crop seal is based on price per tonne and the number of tonnes required. Overhead expenses include the share of administration costs and other standing costs for leasing land not owned. Once the budget data is in, by clicking a report button, the profit and cash flows are calculated automatically. Here we can see the profit and loss and the net result for the year for Farm 2, with net revenues of $827,000, a gross profit of $626,000, and a profit of $87,000 after all expenses and tax. On the balance sheet we can see our debtors, our deferred dairy payment accumulating, we can see our livestock at valuation, our peak overdraft requirement in December of $352,000, a level of creditors, and our long-term debt servicing. On the cash flow, we can see the results of our operating activities, investing activities, and financing activities. We can see here that although our revenues were $827,000, only $639 of milk fat revenues are actually received in the current season. Here we can see our debt servicing, treatment of our opening debtors, creditors, and closing cash balances reconciled back to our net bank balances. If we now run a report for the drivers, we can see the key assumptions relating to the milk solid production and the amount of fertilizers and feed required and when. Now that we've seen how the budget model works, let's have a look at a couple of scenarios. Let's first look at what would happen if the payout increased from $5.80 to $6.40 per kilogram of milk solid produced. To see the effect of this change, let's first save the model as another name, and then change the kg milk solid revenue driver in the copy. Once we've done this, using the report writer, we can pull data from the separate models to produce a year-on-year comparison on the same page. Compared to our budget of $5.80, milk solid revenues are up $170,000 in each of the 3 years. In total, that 70-cent increase is worth $520,000 over the 3 years to revenues. But if we look at the equivalent cash flow report, we can see that cash flows including GST are up by $158,000 in the first year, $187,000 in the second year, and $202,000 in the third. Although total cash flow is up by $475,000, it's less than revenues due to payout retentions. Let's now look at another scenario. We assume that the payout remains constant at $5.80 and we just increase the herd size over the next 3 seasons. Can we achieve a similar effect on profitability and cash flow? To see the result, first let's save our budget model as another name and then increase the effective milkers by 50 cows a season in the copy. If we look at our profit and loss comparison, we can see that revenues are up $101,000 in the first year, which is $70,000 less than the $6.40 payout scenario. But years 2 and 3 are greater, with $210,000 in year 2 and $319,000 in year 3. However, when we look at the cash flow equivalent, we can see that cash flows are now negative for the first 2 years, with negative $57,000 in year 1 and break-even negative $14,000 in year 2, and turning positive again in with $50,000. And of course this is due to the cow purchases of $276,000. So the question is, if we can afford to increase the herd size, what are the other ongoing costs and capacity constraints? Now once the initial model is complete, the monthly process is to now roll it forward and update it with actual results, including the drivers, since these help explain the variances to budget. Here we can see the actual results for July and August and our forecast result for the full year and what our profit is now likely to be. Here we can see the actual drivers for July and August and the forecast activities to the end of the year. The developing trend helps explain actual to budget result variances. If you would like to know more about implementing driver-based forecasting in your organisation, order a trial CD now. Thanks for watching. Bye for now.